how do you react when clients ask you how to value a business? I'm sure I asked you. So how did you react?
The standard approach is a multiple of earnings. And the phrase or the concept you'll hear a lot is EBITDA, which is earnings before interest, tax, and amortization. So it's taking out the sort of non-basic earnings. So it's looking at the basic earnings of the business and how can that be multiplied year on year. So how many years can a buyer rely on that income being available to it, and can they develop it and grow it? And the multiple of earnings will vary a lot. So the standard multiple of earnings for a standard manufacturing business, let's say, would be 4 to 5 times. If your EBITDA is calculated at $1 million, you're going to get 4 to 5 million value for the business. Now that can vary for businesses which are scalable and which can grow much faster. The obvious example of that is software as a service, a SaaS business. If you've got a proven SaaS product, then it's very easy to resell that and to sell it to a much wider market. Selling in the UK, you could sell it globally. So you can scale the business much quicker. And some of those SaaS models will get 10 to 15 times earnings. So in that way, you can get a higher price for an earlier stage business if the concept is proven.
Great. Yeah, no, I think we got about 9 times, so we did pretty well. Thank you for that.
Pleasure.
How should business owners plan to achieve their chosen exit value?
Well, you should start by valuing the business as it is. So most business owners have in their mind what they think their business is worth. That often doesn't match up with a standard valuation mechanism. So it might be 10 million, it might be 20 million. If you've got $1 million EBITDA at that point, you might struggle to get there unless you've got a fantastic SaaS business, for example. The planning is really important. If you've got $1 million EBITDA and you want to get to a 10 million exit and you've got a 5 times multiple, how do you increase your EBITDA so you get to your target exit price? Now that might be increasing sales, it might be changing your customer base, perhaps selling abroad, increasing your management team. So there's a lot of elements to develop the business to, once you've understood how your business will be valued, how a buyer will look at it, to achieving the exit you want. It's not a straightforward matter of saying I'll put my business on the market and get my price.
You talked to me before about the special sauce that a business that has and what you should do with that. Can you say something about that?
So lots of businesses in the Southeast have what we describe as a special sauce. So it's not necessarily a registrable intellectual property asset. It's not, you can't record it somewhere, you can't protect it. But it's a way of operating your business which makes it special. Sometimes that's about the sales methodology, sometimes it's about how the product is produced or developed. But if you can find a way of describing that and essentially pitching it to a buyer and saying this is something we can bring to your operation, then that can offer real value.
How much difference do you think it makes if you can get a kind of view of the special sauce? How much can that go to value, do you think?
If a buyer sees something really exciting that can change their business and help develop their business, they'll overlook a lot of potential problems because they really want that special something. What you've got to work out is how to share enough of it without giving it all away.
Do you think that the special sauce is as important as the management team and the intellectual property?
I think the two things go together. So you can have something special about how your business works. If you can't show that it can be delivered, then it's not worth very much, because everyone can have a great idea, right? You've got to show that you can commercialize it, sell it, and build revenue on it. That's what you require the management team for.
How important is size to all of this? I mean, does size matter when it comes to value?
I think it can do. Size isn't the only factor, but the reality is that as businesses scale, they become more reliable and they become more resilient.
Yeah.
So you've got more customers. If you lose a customer, it has less impact. You've got a more established management team, and you've tested the business in different markets. So it becomes more resilient, it's more reliable. typically, as you move up through the value chain from enterprise value of 5 million, 10 million, 20, 50, the multiples will gradually increase. And the easiest way to look at it is if you think about a private equity model. So when private equity buy a business, they buy a £10 million business, their objective is to scale it to 20 million over 5 years. The reason they do that is that there's an increased profitability, so they'll get that much more when they sell it on a multiple of earnings, but also the multiple will increase as well. So they might have bought at 5 times earnings, they'll sell in 5 years' time at 8 or 10 times earnings. So they're increasing their price, and effectively you can do the same by building your own business.
And is that because of the resilience, because of the scale, right?
Yeah. And you're also you're typically accessing bigger buyers.
And is international generally a good thing in that respect then?
I would say yes, for the businesses. So we've seen some businesses essentially put themselves onto the international map, but do it without setting up a whole global business. So one of the most successful was a business called Kineo, which provided training and coaching for businesses, and they wrote a lot of online material. Essentially, Kineo successfully sold in the end to City & Guilds, which was a global coaching and training business. They did it by essentially franchising their business, so they ended up with half a dozen offices internationally. They picked good people, good individuals, and they said, okay, we'll let you run our business in wherever it was, Singapore, China was another one, and we will give you all the material you need, we'll give you the systems, we'll let you use our name, and we'll do it on a contract basis. And one of the reasons that City & Guilds wanted to buy them was because it tied in with their business, their international business. But it didn't cost Kineo a huge amount of money. They didn't have to set up subsidiaries in different countries.
Are there exceptions to this? I mean, who doesn't follow the standard rules?
So I would say the ones now that have an opportunity of really benefiting from a sale who don't follow the standard rules are the innovative new companies. So if you think back for different cycles in the past, it's exciting new technology that typically will excite investors. So software as a service that plugs into fast growth businesses, that will be, you've got a real opportunity there to get 10 to 15 times multiple. So you can move the business into a much bigger market very quickly with a global company essentially investing in you. And same with AI. We're seeing a lot of AI startups who are super ambitious. They've got a very clear plan for the market they're aiming for. If you can develop your product to a stage where you can show it's commercial, show it's successful, and it has an application, you have a real opportunity to get a great price at the moment.
Okay. Maybe that's what I should be doing now.